Hello out there, and a warm welcome to everybody who is joining us for today's Barchart webinar. My name's Jean Baker, and I'm going to be your moderator today for the session on futures risk management techniques. One of the essential rules of futures trading, actually, for all trading, is that you plan your trades so that they turn into a profitable investment. And of course, we all hope that every trade we make turns into a profitable one. But the hard truth in futures trading is that each trade is going to have a winner and each trade is going to have a loser. And what sets successful traders apart from others is having a solid understanding of risk and risk management and the discipline to carry out your plan. So today, Barchart's John Rowland is going to be leading a discussion of how to set up your futures trades to minimize your risk. Let me give you some background about John and the expertise that he's bringing to today's session. John is Barchart's financial markets educational consultant, and he is here today to share some of the things that he's learned over the years. As you see up on your screen, John has over 30 years of futures trading experience, and he's going to be bringing a unique trader's perspective on how best to use the tools on the Barchart website to your advantage. Now, as always, I need to review the disclaimer that you have on your screen. Today's webinar is being run for educational purposes only, and the information that John is going to be presenting is not a recommendation to buy, sell, hold, or trade securities or any other investment. Your decision whether or not to make a purchase should be based on your own due diligence and not on any representation we make to you. So one other thing I do want to remind you about is that today's webinar is being recorded, and all of you will get an email later on today with the link to the recording. And we also have an archived webinars page on the Barchart website. You can find that under the tools menu, and maybe toward the end of the discussion today, John can take us there and you can see where all these archives are. So with that, I am going to turn my controls over to John and let him educate us today about futures and risk management. Hi, John. How are you?
Hi, Jean. How's it going? I'm glad to have you back. I missed you from last week, so it's nice to have you back with us. So,
thanks.
Thanks for having us, and thanks for being back. Yeah. So before I move away from this slide, today, even more so than in our past webinars, that this disclaimer is even more relevant. And that's because by the nature of the leverage that we're going to use in futures trading is highly risky. And that without, as Jean said, proper risk management, not only could we lose our original capital, but you could also be liable for more losses. So today, what we're going to do is we're going to discuss the philosophy of the trade. All successful traders, as Jean had mentioned, have a trade plan, and this plan is rule-based. It's based on disciplines and is designed to eliminate risk, not only dollar risk, but what we're going to look at is emotional risk, right? You know, how we might screw a trade up or make a mistake, right? We can never eliminate all risks, but a well-disciplined plan will help us eliminate a lot of that. But a plan is not about wishes or wants or where we want to tell the market to go. It's about these disciplines. Dare I even say a religion, all right? And hopefully by the end of this session, I'll show you guys the tools and common practices that have been handed down to me by my mentors that are employed by these traders, but know that what has worked for other traders might not work for you, or might not fit into your plan, but I hope at least it'll help you design your own philosophy. So indulge me here for a second here. This is a chart of the NASDAQ micro, and what I want to do here is kind of go through what I'm talking about, this emotional description. And so just indulge me here that let's pretend that we have a trade that we found, like say down here. And let's just say this is a relative area where we're going to enter into this price action. And if we set up a stop loss, right, let's say our stop loss would be below that. We're saying that, hey, we're going to come in here, and if price goes below here, we're going to stop ourselves out. And the next thing we see is that not only does our trade is working, but it's rewarding us, and it's rewarding us really well. And, every day we're watching this trade go up, and we're thinking, oh my gosh, I'm making more money, right? This thing is going to the moon, right? It's never going to stop. It's never going to go lower, right? I'm going to Hawaii. I'm going to Hawaii, right? And for 16 days, this trade was rewarding us. Now, in futures trading, 16 days, that's 3 weeks of price action. That is a pretty powerful price movement. But then, boom, what happens? In one day, the market falls dramatically. And then in 3 days' time, price returns to where we entered this trade, right? So, in 3 days' times, we gave back all of that potential profit. How much profit in this particular trade? Well, that could be a dramatic amount of profit. This trade, based on the top of that green candle out of this zone, was worth about $2,700. That would be a huge amount of money for any trader to give back in this particular trade, right? But now price comes back down here, and we're still not out of the trade, and we're like, okay, well, it's going to come back, and price comes back a little bit, right? Oh, I feel better about this trade, it's going to work again, and boom, market then stops us out, right? And if I got in, let's say up here, not only did I give back $2,700, right, but I might have given a loss. Excuse me, here would be, let's say that was our entry, and then our exit. Another $400 or $3,100 or $3,200, right? Now, I didn't lose $3,200 per se in this particular trade, but I did. I really did lose $3,200 because at one point we were up $2,700, right? So we're going to talk about this different philosophy, how we can manage our trades, look for opportunities to eliminate risk, and then eventually lock in profits, and hopefully to eliminate some of that emotion that some of us have, right? Okay, so before we get there, we need to understand that all trades start with a stop, right? Where do we get out? Where do we define where we're going to get out? Now, that will be defined by how you look at the setup of trade, how you look at your trends, how you define your trade. But let's talk about a very disciplined part of that trade stop loss, right? So what are some criteria that we can use to help set our stop? Well, we could just use a absolute dollar value, how much we're willing to lose, right, to take that risk on. What am I feel comfortable with it, right? So this is crude oil. This is a December crude oil contract, all right? And again, indulge me here. Let's pretend that we've found a trade somewhere in this range of price here, right? And I've set up a trade where I want to figure out how much I'm willing to risk, and we said that we could use an absolute dollar value. It could be $100, could be $200, could be $5,000. It depends on the individual trader. So we can come to here where it says Tools on our chart, and in Tools, there is something called the calculators. Inside of calculators, there's a lot of these tools that we're going to use in assessing our trades to help us calculate risk, profit, loss, risk reward. So here I'm going to click on the risk reward one. And what's nice about this one, hang on, let me reset my chart here so we can see this a little bit better. What's nice about the risk reward tool is all I have to do is put my cursor over the area where I'm going to put my entry. Let's say we'll go right here. And that will take that value, click once, and then I could put my cursor over where I'm going to set my stop, and then click there, and then it'll record that. And then I could look for a potential target and set that there, and that would set up my risk reward. Now in this case here, you can see I'm going to be doing a short. I'm going to sell up here, and my risk here is $630. Let's say that I only wanted to risk $500, right? So I would have to make an adjustment on that trade. So one of the ways I can start making adjustments is I could either move my entry or my stop. Now, I think a good rule base would be once we set our stop where we decide that where we're wrong, we're not going to change the stop. What we would do would maybe change the entry value. Now, here is crude oil, and how much do I need to eliminate off of this risk? Let's say I wanted to risk only $500. Well, I need to eliminate $130 worth of risk based on my entry. So how could I figure that out? Well, I could do it mechanically or by going to our price overview page. And under our contract specs, we'll see that crude oil, right, it trades in 1 cent increments, and that each 1 cent price change in a crude oil contract will change the contract by $10, right? So $10 for every 1 cent. And if you think about dollars and cents, well, there's 100 pennies or 100 cents in $1. 100 times 10 would give us a point value of $1,000. So going back to our trade, where we set this trade up before, and well, here I used $890. How could I figure this out? Well, I would just say, hey, I need to take $390 off, or $390 divided by $10 a tick, or about 39 ticks. So I'd have to change my entry by 39 cents. And we'll just make it 40. This is so easy for us. And notice now that the calculator has figured this out for us and says that my risk on this short would be $490 inside of my range of risk. And then I could set that trade, look at what it looks like, right, by double clicking on clicking once to set the trade, and then clicking again to show it on my chart. Right? So that would be an easy way to do it. But not all futures markets allow us to do this. There's a lot of different futures markets that trade at different price increments and different point values. And so to do that math might not be that easy. Crude oil is one of the easier ones to look at. So for instance, if we go to the Euro FX, the Euro currency futures, right? And I go to my price overview where I'm going to find my contract specifications. Here you can see that the euro trades in 0.00005, and it's $6.25 a price movement. And our point value is $125,000. Do that math, right? That's going to be a little bit more difficult for us to do it. So that's the value that we're going to find in this profit and loss tool. It'll allow us to make those selections, look at our zones, look for our levels of entry, and to help us to establish the risks that I want to take. This trade would be, perhaps would be too much for me, right? This would be too much for me. It's $1,100, $1,200, right? So maybe I want to come in here and change my value, right? To 120. Let's see what that is. Right now, I've lowered my risk to $468. So use this profit loss tool to help you to find a dollar value that you want to use to help you find risk. Because when we start trading markets like grains, which trade in fractions, right, or treasury notes that trade in fractions, this tool is going to help you with that process. The second criteria we can start thinking about is something called 2% of our risk capital. Now, this is the total size of our account. Now, I know this might sound a little conservative, but it isn't. If we look at a larger sample of trades, let's say a history of trading that you will do, you will discover that about 90% of all your trades you're going to do are going to fall in this between small winners and small losers, right? And that only 5% of your losers are going to make up almost 80% of your total losses. And so what we're trying to accomplish here is to avoid that big loss, right? Let me ask you guys this. Who has had a winning streak? Let's say you've had a winning streak for like 20 days where you're trying to make, you make a little bit of money every day. You had some winners, you had some losers, but every day, you ring the register and you made money, a couple $100, couple 500, 600,000, boom, bing, bing, bang, boom, 3, 4, 5, 20 days in a row. And then all of a sudden you get one day where, you're feeling a little cocky, right? You're feeling like you got it figured out. And all of a sudden, boom, market takes it away from you and you lose 10%, 15%, 50% of your total equity in one trade. I mean, who has done that? Right? All have done that, right? Including you truly. That's kind of a rite of passage that all traders go through that make this mistake. So if we use a 2% risk capital rule, this will eliminate those big losses. We'll never have those big losses. We'll only have little losses, and that's important for us. This is part of that philosophy that we're going to start looking at, right? What is our initial margin, right? We'll look at that as a percentage. Now, this one is a better example for, let's say, applicable for swing traders or traders who have larger dollar value accounts. But as a general rule, we could both styles, a day trader or a swing trader, we could say something in the range of, let's say, 10 to 30% of our initial margin. Again, we're trying to eliminate a lot of big losses. We don't want to take a lot of losses on, so we'll look at how much margin we put up. But I never want to use more than, let's say, 50% of my margin. If I'm taking more than 50% of my initial margin to take a trade, it's probably too risky of a trade for me, and then I need to find some other ways to eliminate some of that risk. All right, the second part, or as we start thinking about creating our philosophy, is so after setting our stop, is now I want to start looking how to pick my targets, right? This is kind of the beginning of the philosophy or trade. We first are going to look for low risk, disciplined stops, and now we're going to look for higher rewards, right? So we can start thinking about in terms of risk to reward, right? What we want to make based on how much risk we're going to take. Now, here we see 3 to 1, 5 to 1, all the way out to 10 to 1. So if I choose 3 to 1, right, as my go, no go threshold, then I only need to be right 1 out of 3 times. Think about that. I only need to be right 1 out of every 3 times to be a profitable trader. Now, this is important because this takes the pressure off of us, right? So I'm only going to look for trades that are going to give me a risk reward of 3 to 1 or greater. Now, if I find a trade that gives me a risk reward that could give me a risk reward, let's say 5 to 1 or greater, well, it's a lot easier to get 3 to 1 out of a 5 to 1 trade. Now, if I'm a trader who is looking to set up trades, maybe let's say at 1 to 1 or 2 to 1, right? That is not enough reward for us, and that doesn't give us room to maneuver as the market starts to reward us, right? So we're going to choose these greater rewards. So there's the first 2 components of our philosophy: low risk, high rewards. All right, so how do we define 3 to 1? Well, we're going to look at our structure, right? We're going to look at our chart and see where is that obstruction, or where we could find price could move freely. Sometimes I call this the clear air or white space on our chart. So we're going to look at that first opposing zone or level that is in our trend time frame, whatever time frame we design our trade in. For day traders, we could be talking about hourlies or 15 minutes or 30 minutes, or some of you might even be using, micro time frames, right? Whatever you're setting your lower time frame trend in, right? For swing traders, we could be talking about daily trends, right? Where is that first area where we're going to find obstruction? Think of it like a speed bump, all right? Or the path of least resistance. And then we also want to start thinking about a secondary target, our second target. But in this, we're going to use a higher time frame, right? So we're going to go above our trend time frame. For day traders, we'll probably look at previous days' highs or lows, or high or low that had come from other days that are relative to where my price action is currently now. For swing traders, we could think about weekly highs or weekly lows to help us set potential targets. Now, what I want you to understand here is we're not just going to take profit at these targets. These targets are going to allow us other rules. All right. So let me give you an example of that one. All right. So again, let's go back to this crude oil. Let's go back to crude oil, actually. Let that come up. All right, let me clear all these out. Clear those tools that we already set up. And I'm going to do this from a perspective of a day trader for this example. All right. All right. So here we are in crude oil, and we're in a monthly chart, but we're looking at 60-minute time frames. And let's, again, indulge me. We're looking at an area where we're thinking about taking a trade. Somewhere's up here, maybe like something like this, right, in this area. Now, it's not important right now why I would look at this zone, but if those have been following my webinars know that I like find where price accelerates away and then comes back and tests that impulse correction. But if I set this trade up, right, and I picked my entry, let's say right about here, and I'm looking at this candle here. If I'm this gets above there, I'm probably wrong, right? So my entry would be at 40.58. My stop loss would be at 40.76, right? Now I need to set a target. Well, here's where price is starting to come back to me, right? It's coming back to me in my trend time frame. And notice right here, we do see price has paused before it comes into our zone, right? Okay. And what I'm going to do here is, this is my first obstacle. This is where price is probably going to pause when it comes back out, if that is the case. So I'm going to set my target based on that obstruction, right? And you can see here, again, we're going to be doing a short. You can see here that this trade does not give me 3-to-1. So that might not be a good trade for me, but I don't want to give up on this trade, right? So what I'm going to do is, a lot of times on these setups, we just might need to make some minor adjustments to our trade to get to that 3-to-1. So for instance, here, my entry of 40.58, right? I might only have to adjust this a few ticks, and crude oil is penny ticks. Let's adjust this 3 ticks. Notice how now my risk reward goes to 3.4, right? So I just made a minor adjustment to get to that 3-to-1 on that trade. Okay. The path of least resistance, right? If I want to go to, well, let me show you this one as it looks as we play it out, right? There's that resistance that could be concerning to me. But if I believe in my trend that this resistance will fail and then eventually price will go lower, maybe as far as this, where the price came back. And so what I could do is, after I get my first target, I could change my target to this target. And now we see that this trade, if I can get that 3-to-1, right, now turns into a 10-to-1 trade. And that would be a really good trade for a day trader. All right. Okay. So I see a question here. Let me stop for a second before we move on. And Rogerio asks, when you talk about risk reward, do you recommend the market starts to move in the direction of our trade, but then reverses before reaching our initial target? Yeah, that's what we're trying to do here, Rogerio. We're not going to make that first zone or that first layer of resistance a target. We're just using that as a criteria for when we do other things, other permissions that we're going to get. And we're going to get to that break-even part in a second. So, all right. So let's change this chart to do a swing trader, right? Right. A swing trader could look at that opposing zone. So for instance, on this one, right, let's remember this trade. We said we're going to come in maybe here. We're going to set our stop there, right? Let's actually set our stop a little bit lower on this one. Let's go down about here, right? And where is that first area where I need to be concerned about, right? This would be where price moved up, right, in our trend time frame, where price went down and stopped and went back up. So I could set that target, right? Now this one does give me a 6-to-1, right? The path of least resistance, right? Now eventually what I could do is look for a larger path, right? Maybe down here if I thought this trend was really broken. And if I did that trade as well, that would give me a greater risk reward. And that's what we're trying to achieve. We're trying to find these zones that are going to give us greater risk rewards. Okay, so day traders, right, another technique that we can start looking at is something called our ATR, average true range. And what we're going to do is we'll look for a target that is a third to a half of our average true range. Now, where do we find that information? Well, we're going to go back into our chart, and here under technical analysis, all right, right here, we're going to look at our 14-day moving average. And so we can see here, 14-day average true range. So you can see here it is 1.65 for crude oil. That's $1.65. Now you notice that we do have some other ones: 9 days, 20 days, 50 days, 100 days. Wells Wilder, some folks consider him the grandfather of technical analysis, designed the ATR based on a 14 period. So we're going to use that term, that 14 period. So let's remember this: $1.65 is our average true range. Go back to our chart. We'll go back to that day trade that we set up. All right. Let me get my tool out, set up my risk reward. And remember, now we had those stats before where we said we're going to come in at 40.61. We're going to set our stop loss at 40.76, right? And that first target was 40.09. We're taking a short. We're risking $150 to make $520, and we're getting 3.47 to 1. So let's think about this. I'm coming in at an entry of 40.61, and my target is 40.09. Well, that's 52 cents. Our ATR was $1.65. So 50 cents is less than a third of our ATR. So this is a good trade for us because it's a smaller price movement in the range of price we can determine for that day, a greater probability, right? And that's what was important. That's the next step of our philosophy: low risk, high reward, and greater probabilities. It's a lot easier for us to capture a third as a day trader, a third of our ATR. What I don't want to do is set up a trade and say, oh, I want to capture the whole ATR as my first target. That is not a probable result. It could happen. And matter of fact, in this trade, we did move that one whole ATR, right? Price went from our entry up here, came into our level, and it did go all the way down to here. So that target down here was $1.60. We're going to try to achieve that, but for that first zone, that first rule to allow us to move our stop, we're going to look at that first opposing zone and try to capture that third to a half of the ATR. If I'm a swing trader, well, we're going to use a 2 times our ATR. We're going to try to capture 2 ATRs. All right, so let's go back to our crude trade again. And now I'm in the 6-month daily, right? And again, I'm going to go back to my tools, right? Set that trade up. There was that entry. There was our stop. And there was that first target right around in here, okay? And I can put it, colorize it. Now remember, this is a short. And I'm going to do my price lines. I'm going to add it to my chart and then click to show the trade, right? Move this out of the way. Now, we said 2 times ATR. So here's a little trick for you. Okay, come back into our tools here, and we're going to pick array. And we said the ATR for crude oil was $1.65. So we're going to look at for 2 times $1.65. So 2 times $1.65 would be $3.30 if my math is right. So let's go down here. Well, I'm going to put array right here at $30. And then I'm going to go up to $33.30. Now, I don't need to be precise as I'm drawing this array. I can right-click on it again and then just change the values. So I'll do $30 versus $33.30. That would be $3.30 in range, right? And so now what I've created is a little yardstick, a little measuring tool that'll allow me to know what 2 ATRs are. And if we look at this trade, right, we can see that our first target is right at 2 ATRs. That would be a good thing for us. That's what we're trying to achieve, right? Now, the other way we can use this, right, and it's a kind of a cool little tool. Some of you will would like this array object, but some of us like to see, a range of price. We could just create a rectangle that is about the same size, right? And again, I could just move that over and see where that fits into my trade, see if that is a 2-to-1 trade, 2 ATR trade. So there's 2 little techniques that we can use to help us define that first zone. All right. Okay. So now the market's starting to reward us. We're rewarding our trade, right? We took a low risk trade. We found a good target, and we have a higher probability of success, right? So now we need some rules of permission to allow us to move our stop loss to break even. And this is what you were asking, Rogerio, is how can I move my stop to break even, right? This is where our philosophy is in 2 parts here. First, if we let a winning trade that achieves our first target and then allow for price to reverse and stop us out for a loss, that's not a good result, right? Think about that. If you have a trade where you set up and you figured it out and it went to your first target and you let price go back and stop you out, that's a losing result on a trade that you were right. That's not what we want to try to achieve, right? Every trade plan needs rules of discipline to eliminate risk, which brings us to the second part of this philosophy. If we can get our stop to break even, again, no dollar loss, this removes not only the dollar risk, but the emotional risk, right? Think about that. Once I get my stop to break even, then I have relieved myself of that emotion of losing a trade, right? Stop in, emotion out, right? Stop in, emotion out. So what are some of the rules we're going to look at to allow us to move our stop to break even? Time, right? We're going to let a certain amount of time pass before we move our stop, right? We're not just going to wait for a price to go outside of our zone, outside our entry, and we're up, $100. Oh, I'm going to move my stop quickly to break even. No, we're going to wait a very particular amount of time, right? So for day traders, we're going to start picking a time frame that is relative to our style of trading and to our time frame. So for day traders, you could use a rule of, let's say, 3 times your trend time frame. For instance, if I'm using an hourly time frame for my trend analysis, I'll wait 3 hours. Or if I'm in 30 minutes or 15 minutes, 45 or an hour and a half, 3 hours. If I'm a swing trader, maybe 2 or 3 days, or I'm going to wait for a price to move above the previous day, right? I'm going to wait a whole day before I move my stop, all right? structure, this concept of that first opposing zone, that first target, right? Once we reach that structure, right, we're going to make the change. We're going to move our stop to break even. This is because now we believe that our trend is in control and that our market is going to continue to reward us on this one. All right, so let's go to another example on that one. And so again, I'm in a daily chart, and again, kind of just indulge me here. There's a nice little rally in the market where now I'm looking for maybe a breakout over here, and let's pretend I got a little entry right in here. So I'll go back to my drawing tool, right, and look at my risk, my risk reward. Let's say I come in, maybe like right about here. I'm looking for this as my stop, and this is that target, that first area of obstruction, right? Again, I could make the adjustments to lower my entry to give me a greater risk reward ratio to maybe get me to my 3-to-1, right? Set that trade up, right? There is kind of my trade set up, right? I'm looking at that 3-to-1 ratio. Now, if price gets above there, right? If price breaks out of this range, then that would give me permission to move my stop from this stop loss position to break even, right? That's what I'm going to try to achieve on this one, all right? So once price reaches our first target, that would give us permission to move our stop to break even. We can start talking about things called thresholds of probability, right? And some of the thresholds of probability that we can talk about is, again, those risk reward ratios, that 3-to-1, right? Once I get 3-to-1, I'm going to move my stop to break even. Now, I know a trader that uses a 1-to-1, right? And the way he trades is he'll trade in 2-lot increments. And once he gets 1-to-1, he takes one contract off, takes that profit, and in essence, that profit covers the loss of the other contract that he still has on. So in essence, he is at break even, right? Now, this might be a good technique for somebody who has a limited amount of risk capital or is just trying to learn how to trade, or maybe is a little nervous about trading. I see some value in this kind of a strategy or this philosophy, but I think this is kind of the training wheels of trading, right? We as futures traders, we're going to embrace risk, and if I'm going to embrace risk, I'm going to take risk on, I want to make sure that I get paid. And 1-to-1 to me is not getting paid, all right? So, but that is kind of, a different type of philosophy that you could employ. Swing traders, again, we could use that 2 times rule, right? 2 times our ATR to give us permission to move our stop. And day traders, again, that same philosophy of setting a first target, right? That 1/3 to 1/2 of my ATR would give me permission to move my stop to break even. All right, now the market continues to reward us, right? Our trade is really working now, right? So now we need some rules of permission to move our stop to profit. Now think about this. This is where our philosophy really gets important, right? We have picked a winning trade. We figured a trade out, right? The trade is rewarding us, right? And the philosophy here is a winning trade needs to pay us, right? This is going to eliminate those trades, like the example I showed you in the beginning of our webinar, where we have a big winner and we let the thing come back and stop us out, right? If we're right and the market rewards us, we want to get paid, right? So this is where we're going to use some different techniques to help us figure out where to lock in price, right? Remember, a trade is only worth what you get when you exit, right? Just because you're up $6, $7, $8, $10,000, and if you're still in that trade, no, your trade is only worth where your stop is. And if your stop is still at loss, then that's all that trade really is worth, because it's not worth anything until you actually exit the trade. So again, we'll look at time, right? We'll look at an additional time unit. So for day traders, if I'm in those hourly or micro time frames, I'm not going to touch my stop for another hour or another 30 minutes or another 40 minutes, 45 minutes, right? I'm going to wait a period of time. For my swing traders, again, we might wait one extra day to move our stop into a profitable position, right? Let's go back to our NASDAQ. And again, let's look at this trade. Let's pretend this is a trade that we have gotten into. So one of the next rules we can think about is something called a technical trailing stop. And this is where we're going to let the trade run out, but we're going to trail our price action with a stop. So again, let's pretend, hypothetical, that we got in somewhere down here. I don't know, somewhere down here, okay? And when we set the trade up, when we set this trade up, we set our stop down here. Now this black line represents our stop. And price starts to reward us, and it goes up and makes a new high. Then price retreats, doesn't stop us out, it retreats, and it makes a new high. Well, now I can move my stop just below the last low. Think about an uptrend is a series of higher highs and higher lows. So we'll move our stop just below the most recent higher low. Then price retreats, and then it takes out that high. Where we're going to move our stop? Off that most recent low. Price retreats, and it takes out our high, makes a new high, and we move our stop to that most recent low. Now price retreats, price breaks our high, makes a new high. Where are we going to move our stop? The most recent low. Now you can see here price comes back. It doesn't break our high, so we're not going to move our stop. We have to wait for price to break our high. Price retreats. Price breaks our high. Now we're going to move our stop. Price retreats. Price makes a new high. Now we're going to move our stop. Okay, and this is called a technical trailing stop, where we continue to lock in profit as the market trend continues to go in our favor. As long as my uptrend continues to make new highs and higher lows, then I'm going to continue to move my stop behind my most recent lows. We can talk about those thresholds of probability, those risk rewards again, right? If I get to 3 to 1, right, I move my stop to break even. Now I get 5 to 1, or 6 to 1, or 7 to 1, whatever that next target is. Now I can move my stop to 3 to 1. That way I'm going to lock in at least a profit of 3 to 1. I get 10 to 1, move it to 5 to 1, right? I'm going to follow my stop is going to follow my risk rewards. As I break a different threshold of risk reward, I'm going to move my stop to the previous threshold. That ATR, remember we talked about using ATR. If I get multiple ATRs for my day trade, for my swing traders, this would be an opportunity for me. Inside of day trading, every third of my ATR, I can move my stop to allow me to lock in that profit. Something called the 50% give back, right? Again, another tool that we have in our calculator, right? 50%. Again, I'm going to click once where I enter the trade, click once where I enter the trade, click once where my maximum profit is, and you can see for this example, if we entered here and our maximum profit was up here, our 50% give back would be here. So I would put my stop there. Notice that in this particular trade, we would still be in this trade, right? Now we talked about that ATR, right? So let's go back and look at our technical analysis for the NASDAQ, and we can see for the 14-day period, it's around 320. Let's just round up 320, okay? Again, I could draw that ray, that little ruler, where I'm going to do 2 times, this is a swing trade, 2 times 320, 640. So let's do that. We'll start at 9,000. That's a nice little reference point. And I'll go up to 9,640. Again, I don't need to be as precise on this. I can just come and right click and change my price to 9,000 and 9,640. So now I have a ruler that represents 2 ATRs. And if I did that for my max profits, now you would see that my stop, right? My stop, whoops, would be right there, right? Again, a little bit closer to current price. Right? Now, another technique that I like, and this is one of my personal favorites, is something called the 3-candle count back. And what this one is a little bit more sensitive to current price, but the theory behind this one is that, if you look at candlesticks or you look at trends, it's usually something happens every 3 candles. You can kind of see that as you become more experienced. You think about candlesticks, an explosive candle, maybe a doji, and then another explosive candle, right? It takes 3 candles for something to happen, right? So if what we're going to do here is we're going to look at our developing candle, the candle that has yet to close. Now let's pretend this red candle has not closed, and we're going to count back 3 candles. 1, 2, 3. And in this case, we would have had set our stop right there. Now notice that that is a little bit more sensitive to current price. Now all of these techniques will give us different results, right? And so the question might be, well, which one do I use, or which one is better? Well, neither nor, right? What we're going to do is, if I'm a conservative trader and I'm about capital preservation, then I'm going to use this whichever stop technique, the ones I just showed you here, that is more dynamic. In other words, one that is closest to current price. If I'm a relaxed trader, I'm willing to take risk, I'm not worried about price returning or giving up profits, then I'm going to take the more static rule that allow me to lock in price. Now it's going to change. It's going to change from market to market. Let's go back to our crude trade. Right? And let's pretend we had that short, that trade that was up here, right? Okay, so first let's look at that 50% retracement, right? That was our entry was up here. Here's our max profit. Where's our 50%, right? That was where we would set our stop, all right? Our ATR, right? Remember our ATR, our tool of $3.30. $3.30 would put us at 33.70, right? Where would our stop be on that? Right about the same spot as our 50%, right? So now we're in the same area. So both of these are giving us basically the same result. But now let's use that 3-candle count back, right? Here or let's do a technical stop first, right? So here we're waiting for that correction, right? Where price is falling and giving us this low, but we never get a correction. So if I was using a technical stop, my technical stop would still be up here around break even. Now, if I did the 3-candle count back, right, price is falling away, then let's just use this red candle, right? And I count back 3 candles, 1, 2, 3, my stop would still be here. And then I get a green candle, I change in price, this might make me nervous. I count back 3 candles, 1, 2, 3. Now my stop is still at break even. See how this technique, even though it might be more sensitive, sometimes here it's a little bit static. But let's move all the way to this candle here, this little one right here. My momentum is slowing, and I'm on this little doji right here. I count back 3 candles. 1, 2, 3. This is where I would have been stopped out. All right. So again, the more conservative, the risk reducing and capital preserving technique, that's the one we're going to use. If I'm not worried about that risk, or I'm willing to let this trade play out for a longer period of time, then I'm going to use the more static rule. All right. So let's see if there are a couple more questions here. Yeah, the 3-candle countback does work a little bit better in higher time frames, but I will say to you, if you get to one of your secondary or tertiary targets then I might drop down to my trend time frame, or I may even go to a lower time frame because I'm getting very close to that 10 to 1, 15 to 1, and I want to try to capture as much profit as possible, right? Okay. All right. What was this question here about, John? Would you mind explaining the initial margin rule again? I'm not going to take that time to talk about margin. The CME does explain the margin really well. I would talk to your broker if you're interested in understanding more clarity about margin in terms of initial margin versus maintenance margin. All right. Okay. All right. Let's see. What if your intent is not to stop out, but to repair the trade? When you talk about risk reward, what would you recommend for markets start to move in the direction of our trade and then reverses before initial target? I think we kind of talked about that. Okay. All right. Okay. So I think we answered a lot of those technical questions. Okay. All right. So let's go back to because I'm running out of time here. I'm at the top of the hour. Okay. So what did we learn? First, every trade starts with a stop, right? How do we define that stop? Well, we're going to use an absolute dollar value, or we're going to use a percentage of our risk in terms of our capital or our margin. We're going to set targets, right? We're going to look for a potential target as an opportunity for us to move our stops to break even. We want to look for greater risk reward ratios, right? Low risk, high reward. We want to find trades that have greater probability, less restrictions, less obstacles in our way, path of least resistance, right? Greater probability. And when we're right, we want to make sure that we get paid. So we'll give ourselves permission to move our stop to allow us to lock in profits, to allow us to take a winning trade home. All right. I hope you guys enjoyed today's webinar. What I did want to remind you guys here is let's see, let me go to my chart here. And for some reason, my layout has, go back to my, there we go. I apologize, technical difficulties here.
Yeah, well, I'm going to pipe in here, John, if you don't mind.
Go ahead.
Yeah, so I do want to remind everybody that the tools that John presented today, looking at interactive charts, using the different calculating tools like the reward, risk, and the P&L tools, those are available on the interactive chart really for any visitor to our website. But in order for you to draw these things on your charts and to retain the drawings on the charts so that they're there the next time you come back and you look at and analyze a trade that you may be in, you do need a Barchart membership. Now, we have 3 different levels of membership. First of all, there is a free account that you can sign up for. And all you do is you put in your email address, you set a password, log in, and we will remember all of your chart settings and all of the drawings and calculator tools that you add to your charts. We also offer a basic membership, but one that removes all the advertising on the site. So look for that as well. And then finally, John is logged into a Barchart Premier account. He's showing you the Premier Tools page right now, but we have this Premier membership, which gives you a huge number of additional tools and features. including multiple different screeners and watch lists and portfolios that you can use to, again, track and analyze all of the symbols that you are following. If you are not a Premier member and would like to explore those concepts more, we do offer a free 30-day trial. So I suggest that you give us a try, take a look. John, you've got a webinar coming up next week as well, using sector analysis as a way to find solid trading candidates. Do you want to maybe give us a preview of what you'll be covering?
Yeah, well, what we're going to do is we're going to use the tools that are in the bar chart, this sector analysis, and we're going to do a top-down analysis. We're going to look at a broader picture of the market or industry groups, and then we're going to drill down inside of those groups to look for trading opportunities in a very particular stock. And we're going to do a lot of what we would call comparative analysis, right? We're going to look for those sectors or those industry groups that are outperforming the broader market, and then inside of there, which of those individual stocks are outperforming inside of that particular industry group or section.
Sounds like an interesting way to start looking for solid trading candidates. We'll look for that information next week, John. And to all of you out there, good health to all of you. Stay profitable in your trades and keep on coming back to barchart.com for all sorts of new ideas to help you. Thanks and have a wonderful day. Bye.